Hi guys, welcome back to my channel. For those who are new here, welcome to my channel. My name is Wanja Waithaka and I am trying to be your business enthusiast. Yes. Yeah. Anyway, it's been a minute. Yes, we came back with an intro. Yes. Anyway, yeah, I'm so excited about the intro, and it was done by none other than Nema. Thank you so much. She actually does amazing work, and she is one of the people who respect customer service. Like, she delivers on time and she delivers what she says she will deliver. That's what mostly impressed me about her. I will just link her socials down below on the description box below. Yes, but thank you so much. Yeah, so when we are back, what are we going to be talking about? We're going to be talking about investments. And when we're talking about investments, basically this is putting money somewhere and expecting future returns out of what you have invested. So that's what we term as investments. So you can invest, for example, in land, you can invest in education, you can invest in like forex or anything. Basically, you're putting money somewhere and you are expecting future returns, probably higher than what you have paid for, right? So basically, in this whole talk for investments, we are going to talk about the life cycle of an investor, and it starts with the accumulation phase. So when you're talking about the accumulation phase, this is whereby individuals will be accumulating money, accumulating assets, so that they can satisfy their future needs. So the people who are usually in the accumulation phase are usually young people like us, maybe in their 20s or probably early 30s, but mainly in their 20s. So at this point, you're taking high risk investments in hope that you're going to get future returns, probably to buy a house. Those are like the immediate returns, and you're also considering futuristic returns, for example, for retirement and the likes. So that's where accumulation phase is. Most people start investing at this time so that they can benefit from compounding, which I'm going to talk about a bit later. So the next phase in the life cycle of an investor is the consolidation phase. The consolidation phase, it's whereby you are at the midpoint of your career and the earnings exceed the expenses. So at this time, since you are earning more than you are spending, you have the ability to save more. You can use excess of what you're getting to save to invest. Yeah, but at this point, people won't want to take abnormally high risks because it will jeopardize the returns. Why am I saying this? At this point, when you are at the midpoint of your career, at that time you probably have a family, you are probably thinking about the education, the children's education. You are thinking that, oh, I want to like move into a bigger house, I want to get a better car. So they will invest their savings, but they don't want to take that extremely high risk, which otherwise, if you were young, if you didn't have a family, you'd have taken. So that is the consolidation phase. And the last phase in the life cycle of an investor, we are talking about the spending and gifting phase. At this point, it starts when you retire. So when you retire, you're benefiting from your earlier investments. So for example, if you had started investing at the accumulation phase, you are benefiting from compounding, which I said I'm going to talk about later. You are benefiting from, let's say you put money in a retirement fund or social security or whatnot. You're going to be spending that money at that time, also trying to make sure that whatever you had saved earlier is taking care of your current and future expenses, and just in case anything happens, for example, medical bills and the likes. Yeah. So we have talked about the life cycle of an investor, where we've talked about the accumulation phase, we've talked about the consolidation phase, and we've talked about the spending or gifting phase. So now that we've talked about the life cycle of an investor, I had earlier mentioned about compounding. When we are talking about investment, you can get your returns in two ways: through simple interest, through compound interest. Most people use compound interest, and I will show you the difference between the two. Simple interest, let's say you invest something like 1,000 shillings and it is giving you and they say that they're going to give you a 10% return every month. This is just an example, every month. What it's saying is every month you're going to be getting 10% of that 1,000 shillings that you invested. So every month you're going to be getting 100 shillings. 1,000 times 10% is 100 shillings. It's simple. There's no complex mathematics. You are just getting the 10% return of what you had invested in. So now when you're talking about compound interest, let's say you have been told, using the same example, you invest 1,000 shillings somewhere and they tell you we're going to give you your returns 10% compounded monthly or something like that. Let's work it out. 1,000 shillings you have in month 1. At the end of month 1, you're going to get 10% of that 1,000 shillings, right? Which will be 100 shillings. So at the end of month 1, you'll have 1,100 shillings. So in month 2, we're going to get 10% of that 1,100 shillings, which is 110 shillings plus the 1,100 shillings. You get 1,210 shillings. So in month 3, you're going to get 10% of that 1,210 shillings, which is 121 shillings. So when you add 1,210 to 121, you get 1,331 shillings. That's in month 3. When you compare it to simple interest, whereby you are getting 100 shillings every month, in month 3 you'll have 1,300 shillings, as compared to compound interest whereby you have 1,331 shillings. So you can see compound interest gives you a higher return as compared to simple interest, and that's what most investments do. The returns are compounded. When we are still in the topic for investment, if I put this amount of money every single month, how much will I have, for example, in 10 years? Or, for example, I want to have this X amount of money in this X amount of years. How much should I put monthly so that I get to attain my goal? So those are the two concepts we're going to be discussing in this video. The two things you will need for this video is an investment calculator and a goal saving calculator, and I will show you how to use which one in which instance. So how an investment calculator works is that it calculates how much you will have after X amount of years using a certain percentage return. What we're going to do is you can just search in the internet for investment calculator. Whatever option you give, they'll give you the same outcome. So there's no specific one that I'm choosing, but you can even click on the first one that you see. So you get the investment calculator. What they have is the starting amount, the duration, the return rate, and additional contribution. And the contribution are you making it monthly or annually? So let's say, let's take an example whereby your starting amount is 5,000 shillings. Most of these investment calculators calculate with dollars, but just assume in Kenyan shillings. It's not going to make a difference. So we put 5,000. So you want to see how much you'll have after 10 years. So you input 10 years. Let's say you put it in an investment that is giving you 10%, which already is compounded, which is going to be compounded. And your additional contribution is 1,000 shillings every month. So contribution at the end of each month, calculate. At the end of 10 years, you will have a total of 212,832 shillings. That is if you start with 5,000 shillings and you put 1,000 shillings every month for the next 10 years, you will have 212,832. So that's how it works. Let's take the other example of, for example, I want to have 1 million shillings in the next 10 years. How much am I supposed to contribute monthly? So here we are going to search for goal saver calculator. So the first option I've gotten is savings goal calculator, investor.gov. So my savings goal, so here I have savings goal, initial investment, years to grow, estimated interest rate, and compound frequency. So my savings goal, as I said, is, let's say, 1 million in the next 10 years. My initial investment, what I have right now, is just 5,000 shillings. Years to grow, as I've said, is 10 years. And the estimated interest rate, I'm still going to use the 10%. Let's say I put it somewhere, 10%, and it's giving me a 10% return. Compound frequency. Some of these investments are usually compounded annually, are usually compounded daily or semi-annually. So I'm just going to choose semi-annually. If I am to get 1 million shillings by the end of 10 years, and I am starting with 5,000 shillings, what I need to save for the next 10 years is 4,973 every month. So roughly 5,000 shillings. I'm supposed to put, on top of that 5,000 I started with, I'm supposed to put 5,000 shillings every month. Yes, so those are that's the difference between the goal saver calculator and the investment calculator. The investment calculator shows you, if I save this certain amount of money every month with this return, for example 10%, 15% or whatever, how much will I have within the next 10 years, 15 years, 20 years? And the goal saver calculator tells you, if I want to get to a goal of, let's say, 20 million in the next 20 years, how much am I supposed to be putting monthly, considering this is how much I am starting with? So those two can help. However, they are not completely accurate, and these are the reasons why. Reason number one, they don't take into consideration tax rates. So, for example, you might put your money in an investment and there is, for example, a tax rate. There's a tax deduction, for example, capital gains tax. Another thing it doesn't include is bank charges. So within that period of 10 years, 15 years, 20 years, you're going to incur bank charges. For example, 2% of what you have, 3% of your investment or whatever. It does not include that. Another thing it doesn't include is interest rate fluctuations, which could happen even because of the economy or something. There are some funds last year that were giving a return of 11%. Right now they're at 10% because the shilling has depreciated. So it also doesn't take into consideration interest rate fluctuations, whereby it could rise, it could fall in the future because of certain reasons. Another thing it doesn't look at is that probably right now you're starting with 5,000 shillings and you're depositing 1,000 shillings every month. In future, you will probably have more to put in, or you'll probably have less to put in, depending on your priorities at that time. So you're probably starting with depositing 1,000 shillings every month, but you might probably get a good job and you end up depositing 20,000 shillings. So it doesn't take into consideration future needs, but it's a good estimate of where you want to be at a certain period of time. It kind of tells you, if you want to get here, this is what you have to do. Yes, when you are looking at investments, again, you have to look at yourself. Are you a low-risk investor or a high-risk investor? When we were talking about the life cycle of an investor, it assumes that if you are young, you are probably going to be more high risk because you don't have certain obligations. For example, you don't have a family. Some of you people still live at home, so you have the ability to aggressively invest because even if you lose money, it's not affecting someone else exactly, because you'll still have a home, you still have food. It's not like other children are depending on you, whereby if you invest aggressively and you lose everything, you won't have money for school fees. Yeah, so that is the assumption in the beginning, whereby like high risk, high returns. You're also looking at your future, you're looking at your retirement, you are looking at the rate of compounding, like between now and the time you're retiring, like you'll have accumulated so much. So type of investments, you have low risk investments and we have high risk investments. So low risk investments are, for example, bonds, infrastructural bonds. These are government bonds. I know I haven't talked so much about it, but I will in a future video. But these are government bonds. They range between 11% and 13%. Yeah, around there. People actually say they're risk-free because the government is a permanent institution. It's still going to be there in the next 30, 40 years. That's why it's low risk. Somehow they're still going to pay you back your money. However, with infrastructural bonds, the minimum amount you can put in is 100,000 shillings. We also have money market funds. I've talked about money market funds. I've sung about money market funds for so long. Yeah, but with money market funds, you can start with as little as 2,500 shillings, and they offer an interest rate of between 7% and 10% or 11%, depending on what's going on at that particular time. Yeah, you start with 2,500 shillings. So you can see you can start with a small amount of money investing in low risk investments. So when we go to high risk investments, these are basically, okay, anything that is above 13-14% is high risk, because a risk-free investment is around 12%, 11%, 12%. So examples of high risk investments are company bonds. For example, before Nakumatt collapsed, it had issued out a bond which was paying around 20%. That is way above what you get with infrastructural bonds, which is around 12% or 13%, as I mentioned. So that is a very high risk investment. Another example of a company bond is the bond that was raised to build Kwetu. A lot of us are familiar with Kwetu because these are student residencies, residentials, you know what I mean. Yeah, but to develop Kwetu, there was a bond that was issued for 5 billion. So out of these two examples of bonds, we can see how there's a high risk. You can invest in a private company, you can invest in a company that's giving you a 20% return. In like 3 to 6 months it crashes. On the other hand, we are seeing that you can also invest in a high risk company and actually get your investment back. Okay, I'm not so familiar with the Kwetu. I just know they raised money in form of a bond to build Kwetu. However, I don't know the nitty-gritties of the bond. For example, now that people are not in school, have the payments stopped? What was the duration of this bond? Anyway, I don't know, but this is just an example of a high risk investment. Another form of high risk investment is forex, whereby you can even get like a 35% return in one day, even 50% return in one day. However, you can still lose the same amount of money in one single day. Also stocks, when you're investing in companies individually, a company can be doing so well today, coronavirus happens, it shuts down, the stock prices go to negatives. We were seeing when coronavirus started, KQ was trading in negatives. So someone who invested at that time, which was like -1 shilling or -2 shillings, right now it's at 2 shillings. That's like ×4. They have gained ×4. However, if you invested before then and then during the coronavirus, your money declined by 4 times. So you can see how it's a high risk investment. Otherwise, that's all I have for you for today. If you have liked this video, please give it a thumbs up. If you haven't yet subscribed to my channel, please do so. Yes, I hope you have learned about investments. If you want to learn more about the low risk investment, specifically money market funds, I've done a video on it. I'll just link it somewhere over here. And if you also want to know how to manage your expenses so that you reach a certain amount when it comes to savings, I've also done a video for managing your expenses. I'll also link it somewhere around here. Yeah, and if you have any questions, anything, hit my DM. I'm always open to answer your questions if I can. Yeah, if I have the information, if I know, I'll be able to help you. Yes, I hope you guys will have a good week, a good weekend, and I will see you guys next time. Bye.